So, how many of you guys have been in real estate for longer than a year? Okay, cool. How many of you guys have been in real estate longer than 5 years? Okay, longer than 10 years? Okay, so we got some good. So if you've been in business for 5 years, right, you've seen a lot, but you've also seen a lot of not real market environments. Like what happened in COVID is unprecedented, and it's not like traditional real estate. Okay, so what we're going to talk about today is what it actually takes to be a successful salesperson in an environment that's really volatile. Okay, so for those of you who don't know who I am, I'm Lizy Hoeffer. I've been a residential loan officer for the last 22 years here in the Valley. So I saw when interest rates were originally at 7%, I saw them drop all the way to the 5s, which was like historical for that time. I saw the boom, the Great Recession, the recovery, you know, the COVID years, and then whatever we're going to call this, okay? So I've seen a lot of different markets, and I will tell you that this particular market is going to require people to be experts in real estate and investments. So traditional real estate has been very heavily done by salespeople, okay? And a salesperson, guys, is the type of person that sells you on a product, an investment, a deal, a service, right? They are convincing you, right, that their product is best. An advisor presents facts, good and bad, and helps the client make a decision on something like an investment, okay? We get compensated for being advisors, right? But we are competing against a lot of people who are just sales, right? They're just making the calls, they know the scripts, they know how to get people off the fence. And that works in an environment where there's low rates and lots of opportunity, okay? In a market where there's high rates and the market conditions are uncertain, you have to have high level of expertise. Not to mention you guys just went through a huge commission change, which means that you also have to validate your worth, right? Because now we're having to discuss that worth on a regular basis. So how do you become an actual real estate expert? So just throw out some things. What do you think is an expert versus a salesperson?
They know demographics.
They know demographics. What specific demographics?
Stuff about like, I guess, house price trends and data market and just.
Okay, so they're area experts, right?
Yeah.
So what he's talking, and write this down, guys, because if you don't know this is information you should know. Okay, so for your specific geographic area, you need to know time on market, okay, time to contract, right? You need to know average sales price, average appreciation. You need to know what neighborhoods have different appreciation rates, right? So a zip code could have an appreciation rate where a neighborhood has a different one. Okay, so like Arcadia is a very good example of that. Okay, Arcadia proper appreciates differently than Arcadia Light. It appreciates differently than Paradise Valley. All same zip code. So you need to be a market area expert. In addition to that, you don't need to know just current markets. You also need to know historical markets, and you need to know how to predict the data. So a lot of people, especially people on social media, they're hype people. Have you ever noticed that it's always a good time to buy? Like, it's always a good time to buy. It's always the best time to buy. And while some of that is true, right? Like if you were somebody who purchased a piece of real estate in 2018 when interest rates were going up and there was a recession around the corner, that would be true, right? An investment in 2018 is a great investment when compared to today. Okay, but you have to understand real estate as an investment to even make that statement. Okay, so a couple things to write down. Real estate in Maricopa County appreciates by double, like it doubles in value every 10 years. The national average is 20 years. Okay, so if you were to buy a piece of real estate and own it for 20 years, you would double the value of the house. Okay, that's pretty huge. That's life-changing value. Now, for most people, they will put somewhere down between 3 and 5%. They will see 100% return on their cash investment, which is different than appreciation, right? Within somewhere between 3 to 5 years, depending on their property's appreciation. Okay, does that make sense?
Mhm.
So real estate as an investment can do multiple things. It appreciates, it can cash flow, it's a tax deduction, okay? It can be used for a variety of different things, right? Business use, home use, farm use, commercial use. I mean, there's a lot that real estate can do from an investment standpoint, okay? Now, an expert knows, right, those appreciation terms. All right, so here's how you guys need to start thinking, and it's not the same for everyone. You have the same market data, but your clients need different things. Would that be true? Like a first-time home buyer is gonna need something different than a move-up buyer that needs something different than somebody who's downsizing and an investor. Like they're all different types of buyers. Different price points have different needs too. Like it isn't not just the same for everyone. And so you need to know that. So if you do not know who your niche client is, and that is the, like if you had a review of all of your past clients, if you looked at all of the leads, the avatar, so like the first time home buyer buying in $400,000 price point in 85016, buying a single family residence, that's your avatar. If you have the majority of those people, you have to solve their needs. Okay, so you have to identify that avatar, and then you have to understand what their biggest problems are. So for the longest time, my avatar has been first-time homebuyers. I've worked in the mortgage industry primarily with first-time homebuyers for 20 years. Okay, I know that first-time homebuyers' biggest obstacle in buying is cash. Like it's money down, it's money to close in terms of closing costs, and it's also the monthly payment. Okay. Money is their biggest hurdle. So for me, I have to teach them strategies for how to save a down payment, how to maximize their buying power and their budget. And I have to use market stats not to freak them out, because a lot of first-time homebuyers today were children when their parents were losing their houses in the Great Recession. How many of you guys have financial trauma from your past? Okay, I do. Like my dad had a foreclosure, multiple bankruptcies. My mom was a single mom who had to work 2 jobs. Being poor impacted my life profoundly. Okay? And when I make a financial decision, I have a lot of financial memories, hashtag trauma, right, that I base those things off of, right? And you have to understand what those big fears and obstacles are. So in order to be a really good advisor, you have to know 3 things for your client. What is the tangible benefit that they will get from your services, from your advice, your expertise? So that means I save clients $200 a month, right? $200 is an actual figure that they can take home with. Right? So as a real estate agent, things that you should know, and write this down, is your buyers. How much do they get in concessions? Go back, look through all of your past closings. How much have you negotiated off that purchase price? How much have you lessened their cash burden at closing? You can also look back and see how have those investments performed for the last 5 years, those of you who have been in real estate. They probably have really good performance, especially because 2 of those years had like 30% appreciation, followed by like 20% appreciation the next year. I mean, those are really great. And if you have stats from like 22 and 23 that had good performance on them, I would compare that to what the average salesperson sells at. When you can quantify it, it matters. So a couple of stats that you'll want to know in comparison to a market like 2021 is that in 2021, when things were super aggressive, okay, the median concession, and median is not the same as average, so median means that it's the midpoint. So 50% is below, 50% is high, okay, higher than that figure. So it was $3,000 was the seller concession on a purchase contract in 2021. That's typically a repair cost on a Binzer. Okay, that is not closing costs. Today, the midpoint is $10,000. That's a huge difference. That means, again, 50% of buyers are getting over $10,000 to reduce their closing costs, to pay for temporary buy downs, to pay for repair costs. Okay? In a market like the one that we have right now, it's considered balanced, right? So you get 3% haircut off of what people list their prices at. Okay? Now, it's a 3% discount right now. So a 3% discount plus $10,000 is equivalent to about $30,000 in somebody's out-of-pocket expenses. That's a huge number. Okay, that is tangible benefit. Now, next to tangible benefit, you have to understand, what does this mean to your client? So what does a $30,000 savings mean to your first-time homebuyer? Well, that's oftentimes the difference between buying a house and not buying a house. Okay? When you buy a house, remember when I said you get 100% return in 2 to 3 years? Well, the average first-time home buyer that buys with us, and I'm saying average, right, because I did an average, so not the midpoint, of all my clients with me, makes $100,000 in return after 5 years. Okay? $100,000 is tangible, but what does $100,000 mean to a first-time home buyer? How many of you guys know people who are able to save $100,000 in 5 years? Yeah, no one, right? This is $100,000 is people's lifetime savings. In addition to the fact that $100,000 is a number that most people try to achieve in their lifetimes. So the first big income goal is $100,000 for most of you entrepreneurs. Okay, $100,000 in savings is life-changing money. That's quantifiable. That's what that means. Now, the next thing you have to understand about your expertise is it guaranteeable? Like, can you replicate it? So I have a formula for buying that will replicate a 6-figure return. Now, is it perfect every time? No, because I don't control the semantics of every single investment. But I do know that over the long haul, 10 plus years, this investment should perform. Real estate has proven the test of time, best investment there is in comparison to anything else. Less volatile, provides the utility of living in the property, it cash flows. I mean, it's amazing. Okay, it's the best investment, stood the test of time. Okay, but does your expert advice on how to buy a property, right, result in tangible, quantifiable value that you can replicate? Okay, so I have something called the Smart Sense budget, which is where I teach people how to save $200 to $300 a month, and in 3 years they will have enough money for a down payment. I've taught it for 20 years. I can replicate it in my sleep. Okay, if they follow the budget, they will be a homeowner in 3 years or less. Okay? That is stuff that you have to be able to brand to you. Now, I am not the inventor of a budget. Okay, I'm not the inventor of home loans. I'm not the inventor of any of these things. It is a pathway to success. Does that make sense to everyone? Okay, so I want to now kind of segue into what you can expect for the market in 2025. Okay, so back in May, they started talking about the Fed funds rate reduction. Okay, are you guys familiar with what the Fed funds rate is? Wait, what do you think it is?
Fed funds rate just has to do with like car loans, credit card debts, and stuff like that. The interest rates on mortgages track the treasury bonds. So.
Okay, that is a good-ish explanation. Okay, so the Fed funds rate is arguably the most powerful investment rate that there is globally. Okay, and the reason for that is U.S. currency is the reserve currency of the world. So the Fed funds rate is the rate that the Fed sets, so our Federal Reserve, and it's the rate that the federal government can borrow from itself, and it's also the rate that banks borrow from each other overnight. Okay. Now, the reason it has impacts to short-term financing is because it has direct correlation to short-term lending. Okay. Mortgage-backed securities are a vehicle in which mortgages are traded and loaned out, okay? Because mortgages have multiple value, right? We have the value in just doing the home loan in terms of fees, But the biggest value on a home loan is actually the interest collected over time, and that's known as servicing value. Okay, so the reason it's not totally impacted by the Fed funds rate is because it's actually impacted by its own investment vehicle. Does that make sense? So the price of mortgages is actually more dependent on the value of that servicing portfolio. Okay. Now, in recent history, right, when the mortgage interest rates were in the 3 and 4%, servicing value was the highest it's ever been because the likelihood of people wanting to sell or refinance was very low. Okay, so when the value of servicing is high, okay, mortgage interest rates are low. Does that make sense? When the servicing value of a mortgage is low, like an 8% rate, where it's very likely that there's going to be a refinance boom in the future, right? 5 years, 6 years, it's in the short term, right? Then you see mortgage interest rates high, right? Because that short-term gain has to be made up somewhere, okay? Now, the Fed funds rate will impact banking and profitability over time, so it does have some impact to mortgages. It's just not immediate, okay? And so when they talk about Fed funds rate reductions, we typically trade in anticipation of, right? So when they start talking about it is when you see mortgage interest rates fluctuate. So they've been talking about this, and why I bring this up, and this is very high level, guys. I'm putting together a 2025 forecasting guide, so if you want that, you'll want to sign up with Kristen, that I can send you that breaks this down. But I want you guys to understand this relationship, okay? So you heard him say that mortgage-backed securities trade according to treasury bonds, okay? They trade in parallel, meaning that what the treasury does typically is how mortgage-backed securities trade. And that's because they're very similar investments. So a treasury is long-term, typically pays somewhere between 3 and 5%, similar to a mortgage. Okay, so what a treasury does, because they really track that, is generally speaking how mortgage-backed securities will trade, and how we forecast interest rates is based on a spread between the value of the 10-year treasury note and the value of the servicing portfolio as it stands today. Does that make sense? It's very high level. I don't expect you guys to remember this, but I want to give you some metrics that you can use right in your scripting for clients. Does that make sense? So people often ask me, like I think the top 3 questions are, what's going to happen with interest rates? Like, is this really a good investment that I can afford? And is the market going to crash? Are these yours? Top 3 questions? Any other questions? Okay. So what we do when we're trying to forecast interest rates is we use the Fed funds rate as a measure, we use the 10-year treasury note, and we add in the spread for servicing value. Does that make sense? I don't want to lose you, because this is like 20 years of mortgage nerdiness that I'm trying to spew at you. And so if you don't understand it, I'm happy to, like there's a small class today, let's go over it again. Does that make sense, what I just said? Okay, so when they start talking about the Fed funds rate, it's typically within 60 to 120 days of actual movement. So they started talking about it in May. We saw the first reduction September. Okay, now that reduction was bigger than anticipated, right? They were expecting somewhere between 25 basis points and 50, and it turned out to be 50, which was great. We saw mortgage interest rates drop, though, starting August, right? We saw a pretty significant reduction, about 1%. Okay, and that's, again, that whole in anticipation of. And then when the actual Fed reduction happened, we've now seen the opposite impact, right? We've now seen interest rates go up. Now, the reason for that, guys, is just know that the market will never go like this. It doesn't trade like this. It trades in staircases. So it goes up, it goes down. It goes up higher, it goes down. Or it goes down lower, it goes up. It's like a staggered staircase. Okay, and it will always be like that because there's other economics at play. Inflation is one thing that you have to pay attention to. Unemployment is a thing. The election, you guys, is causing some unexpected turmoil this week in the mortgage market. Interest rates are very close to 7% right now, just so you guys know. Now, that does not mean that interest rates are going to stay at 7%. For the last 2 years, interest rates have peaked September, October. They were 8.25% last year. Okay? They will drop again at the very beginning of the year because unemployment is seasonally high right after Christmas, right after the holidays. Okay? And the other thing is that holiday sales never measure up to what they predict. Okay, and people's biggest concerns right now are not big TVs, it's their groceries. So there is a lot of expectation that holiday sales this year will not perform, and then we'll have significant unemployment at the beginning of the year. Okay, so if history serves us, right, we should see significantly lower rates starting January. Okay, so I want to tell you what we might expect, okay, in the next 6 months. So, and I wrote this down for myself because I don't want to memorize this, okay? Well, I do want to memorize this. I doubted that I could memorize it, so I wrote it down. Okay, so on the peak, so when the Fed funds rate peaks, which it peaked at 5%, okay, from the initial rate drop, okay, which was September, so it peaked at 5% October 2023. Okay, our first rate cut September 2024. They dropped it 50 basis points. We normally see, right, the Fed, the Treasury drop 1.4% from whatever the Fed funds rate is, right? So wherever the value was, it'll drop somewhere between like 1.4%. Okay, so it started, right, at 5%. We saw it drop to 3.7% in terms of value for a 10-year Treasury note. Okay, the spread today is about 2.5%. So if you add 2.5% to the 10-year Treasury note, that's typically what a 30-year mortgage is. This is not exact science, guys. They trade in parallel, which is not exact. It says that when this happens, this usually happens. Does that make sense? So I think it was like Albert Einstein said, history never exactly repeats itself, but it rhymes. This is like what I'm talking about. So it does this. All right, so if you gauge what that does, right, so we should see in the next 6 months, interest rates get as low as like 5.5%, 5.25% if the spread was to reduce based on historical measures. Okay, from where the 10-year Treasury note is. Does that make sense? Let me do this one more time. I just want to write this down. Okay, so I want you guys to really get it. So the Fed funds rate, well, let's hope the verbal marker works. All right. So the Fed funds rate peaked 5%. October 2023. Okay. We saw our first reduction September 2024. Okay, spread today is 2.5%. Okay, and the value of the 10-year Treasury note was 3.7 when that happened in September. Okay, so if you add these two together, can somebody add them on their calculator because they're cool like that?
6.2.
Okay, right? So before all of this madness happened with the election, right? This is where interest rates were for a 30-year fixed mortgage on a conventional note. Do you remember seeing that a couple weeks ago? Okay. Now, the reason this is not an exact science is because, okay, we have election headlines. We have Fed chairmen that do press conferences that talk about what they feel is going to happen with inflation. We just had an inflation report that was a little hotter than people's expectations were. And so then, all of a sudden, you start getting market movement based on other people, investors' interpretations of what might happen. Okay, and that's the volatility that we see. This week, apparently, the market is pricing in a Trump win for presidency. Okay, that could very quickly change too. And if it changes too, let me tell you, as swiftly as interest rates rose, they will change again, right? It's all based on this, okay? So just know that when you're looking at like a bird's eye view of what's happening, right? This is what typically happens if you're gonna gauge like a 30-day period, but it's not exact for day-to-day trading, okay? So when everything calms down, because it always does, there is more economic news on the horizon all of the time, okay? Nothing changed with the economy, just so you guys know. The unemployment rate is very, very unreliable, okay? But it is something you have to track. First Fridays of every month, they release an unemployment report, okay? Right now, they consider unemployment to be 4.1%, okay? Now, the BLS, though, has revised, okay, their job number by 818,000 jobs. This is crazy, you guys. This means that 40% of all of the jobs that they stated that were created this year never existed. That is crazy, you guys. And what's even more nuts is the market trades on that information every single month, regardless of the revisions. It is nuts. And I don't want to go into conspiracy theories. I don't care to, it's just all that matters is that we have to pay attention to it. The other thing that you have to pay attention to, guys, is inflation. Okay, inflation reports come out several times a month.
Quick question on that. Don't they revise it every single month?
Yeah.
The past month, every month?
Every month they revise it, yeah.
And so then we just don't see those actual numbers.
No, you do. They just don't trade in anticipation of it because the market, the reason they don't trade anymore is because whatever's happened with that unemployment has already been factored into profitability and whatever's happening in the market. Like, we trade forecasting, not what happened in the past.
They usually only,
The revision actually occurs, and we don't know that revision for another 30, 60 days after that number is reported.
Like nobody pays attention.
well, they
No,
usually
a lot of people
yeah.
pay attention to the
Yeah.
revisions. It's just that,
It's past.
like, if you were gonna trade and make an investment, are you gonna trade on what happened 3 months ago, or are you gonna try to trade on what you think is gonna happen 3 months from now?
they're
Right.
usually already accounting for like 140 to 160,000 job miscalculation. 880,000 blew it out of the water.
Oh, yeah, it just doesn't, yeah, it's just,
So,
yeah, well, it's because people die and are born every single month and people retire and it's really hard to predict. It's just never been this off historically.
yeah.
So, but the thing is, it's never going to be, like the revisions will never impact the market because the only thing that matters to investments is what's going to happen in the future.
Are you thinking that COVID changed all of that? You know, because if people were still spending money even though they didn't have jobs.
Here's what I know is really impacting the job number is that, one, more so than ever, people have multiple jobs to make ends meet. And so when they do a household survey, it's them calling people and asking you, are you employed? Right? And so if you have a part-time job, you'll say, I'm employed. Right? And so if you look at the actual overall number for people who are just no longer re-entering into the market because they've been unemployed for more than a year, or you look at what part-time work is, we're actually closer to 8% unemployment, which is pretty significant. So it is something to consider, and those things have not changed. Okay, when you look at, if you really break out the employment numbers, what you're really seeing is that there is a lot of part-time employment, not full-time employment. These are not real, not that part-time employment is not real jobs, but it's not full-time employment that matters in people's buying powers.
And economics,
Yeah, so we're talking about, and the age brackets are like under 20 and over the age of 59.
Wow.
Right? So those aren't your high income earners either. And so the employment market is much weaker than people really understand. In addition to, we've had a lot of weird things happening. We have a lot of global conflicts. We just had that strike happen that regardless of how people feel about it, 1 or 2 days without without goods moving has a multiple month impact on the economy, period, the end.
And October's the fiscal year or the fiscal government spending starts in October.
6 month trailing average too, usually when those take effect, it starts to show up in about 6 months.
1,000%. And this is the time, okay, when investors are doing their fiscal planning and they have to do their reporting, and so they're trying to make their numbers look as good as humanly possible. They're trying to say, this is how profitable we are, this is how good we did, this is what we're predicting our holiday sales to be, this is the latest thing that rolled out. And unfortunately, because of all of this right now, there is a lot of pressure on people's spending. Like all the people who went out and crazily bought toilet paper and water and all the things because they were worried of the, the strike causing the apocalypse, right? Like that also drives the cost of goods and services up. Okay, so just so you know, so you'll want to pay attention to inflation. Okay, now this is the time of year we normally see it higher, right? We have bad weather, right? So energy costs impact inflation. But you want the Fed's number one measure of how they track inflation is actually the the PCE, the personal consumption expenditures. Okay, that's the one, and they take out the core, which actually removes food and energy because those two things cannot be impacted by monetary policy. I mean, the cost of food is immediate, the cost of energy is immediate, right? Those things aren't long term. And so that's one, and then the secondary is the CPI. Most real estate agents typically know of the CPI because that was originally the measure of inflation that the Fed paid the most attention to. Okay, so PCE, CPI, unemployment. They're all reported by the BLS. So if you want to put these down as just like a Google ticker, right? Or if you want to, follow that news on, I get a lot of my economic news, believe it or not, on, I think it's X, I want to still call it Twitter. I follow a lot of economists there, but you can follow those hashtags, and every time something comes out, you will now see the latest information. Okay, but those are the three things you'll want to pay attention to and how they impact. So just so you know, anything that's good for the stock market is bad for the mortgage-backed security market. So when things are more profitable, right, when people anticipate things being better for business, like a Trump presidency, and I do not care what your politics are, by the way, it's just this is how the market trades, we will see mortgage interest rates rise. This is a no news week for mortgages. Like literally nothing economic has happened. China decided to stimulate their economy, and now all of a sudden a bunch of polls are saying that Donald Trump's going to win, so now the market hates us. Right? It's just what it is. The market loves, to price in those types of things, and so unfortunately interest rates are now close to 7%. It is so temporary.
It's also because of BRICS too. Xi Jinping and Vladimir Putin just met and had a BRICS summit with Saudi Arabia, now doing joint operations with Iran. So there's a lot of...
There is global conflict,
Yeah.
but for the last 2 days when like Monday, specific Monday, because that's when we saw interest rates shoot up, okay, there was no news. Like every single economic report that I read was like, we have no idea what's going on with the market right now. There is no news. Now, these are all people's guesses, right, and impacts, right? But a couple things you also need to know about a potential war, too. So, in war times, the federal government has to borrow from itself, which means the Fed funds rate cannot stay at 4.5%. Period, the end. Like, the government will not borrow from itself at such a high interest rate, okay, and it typically stimulates things like real estate because it impacts 30% of the overall GDP. So in military conflict times, you have lower mortgage interest rates because of Fed stimulus in buying mortgage-backed securities. Okay, that's what drops the interest rates when the Feds get involved. Does that make sense? So if that were to happen again, it's just temporary. When that stuff happens, we will now see a reduction. Now, this is what's important to find out. So this was the peak, right? So this is the peak. So typically what we have seen in the past is that the benchmark, right? So when they see this fall, right? So this is the 10-year treasury note from when it gets to the bottom, and we have no idea how low the Fed funds rate will be. It's typically, you guys, another 1.5% reduction from this rate is what the treasury value is. Okay, so does that make sense? So if you take 3.75 and you knock off 1.5%, what are we getting? 2.2? Okay, Now, when we add in our spread of 2.5, where are our interest rates? 5.7, okay? Now, should it go lower, right? So 2.2 in reduction to this, right? We should see interest rates fall somewhere around 4.25%, okay? That's where they expect interest rates to drop to when stimulus gets to the bottom, when they stop lowering the Fed funds rate. Does that make sense? If we follow history. Okay, so is your business prepared for interest rates to one, be at 5.25%, 5.5%,
Yeah, right.
or is it prepared for 4.25%? Okay, so what will happen? Okay, so I've now told you the types of things you need to pay attention to. Did everyone get that? Right, we need to pay attention to wherever the 10-year treasury value is in relation to these Fed funds rate cuts. Okay, now the Fed funds rate typically takes about 2 years to bottom out, is what we've seen from the first rate drop. So it could be 2 years before we see interest rates bottom out at 4.25. The timing is the hardest thing to predict because there's so many things that happen, right? Like COVID, I mean, they dropped it down to 0 in a historical amount of time. So we just have no idea when it'll actually bottom out. So just know that it's historically around 18 to 24 months. And what do you need to know? So in the next 6 months, they anticipate interest rates to be in the mid-5s. Okay, that'll start in January. So whatever happens between now and then, we have to communicate that high interest rates are a buyer's best friend. Why are they a buyer's best friend?
Keeps competition out.
Keeps competition out, so it drives demand down.
And because prices aren't going to be as high. So.
Okay, so it keeps prices down. What else?
Sellers are a little bit more willing to negotiate.
Yes, and what are they willing to negotiate
Seller
on?
closing costs and credits, yeah.
Okay, what else are they willing to negotiate on?
Your pay.
And interest rate
Your
rises.
compensation,
Yeah.
right? And repairs, right? And timing. It's when your contingencies can get accepted. It's when your veterans get a home loan. It's when your FHA buyers with 580 FICO scores that need an arm and a leg, right? This is like when they can buy. High interest rates, guys, are everybody's best friend. So how do you communicate that? Because if you just communicate that high interest rates will lower demand, right, it's not enough, right? It's not that tangible value that you need, right? We can say, hey, you'll get a $30,000 savings, okay? But people, just so that you know, what matters most to almost every single buyer is their monthly payment. Like that is literally the thing that will, like they will lose $30,000 to save $176 a month. Isn't that crazy? This is why people buy when everyone is buying, because they just don't want to miss out of an opportunity. FOMO is a real thing. So then you guys have to explain what the tangible cost of waiting is, okay? So I did a scenario here, and again, I'll send this to you guys so that you have it, but on what the cost of waiting looks like if somebody were to buy a $700,000 house. And I chose $700,000 because a first-time home buyer used to be around like $400,000. Move-up buyers are typically in this price point now, and we've seen a larger percentage of people buying over $1 million in this price point. We are like quickly becoming a moderate affordability, right? So we are not good affordability anymore. Arizona has moved out of that. Okay, so I wanted to give you a real scenario for your move-up buyers, because these are the people that are the most reluctant to give up a 2 to 3 to 4% interest rate. Okay, and they are tripping over dollars to save pennies. Right, like that's what this market is. So, okay, so if you were to buy a property, and mind you, I just gave you a 6.25 rate because that's where this is all based on. Today, interest rates are close to 7. It still works if you just want to update the scenario, but I believe that interest rates will be back to 6.25 fairly soon, right? Okay, but here's what you gotta know. $700,000, 20% down payment, which is $140,000, loan amount's $560. Okay, the scenario is going to be the same between scenario 1 and scenario 2. So scenario 2, say the interest rates drop to 5.25%. Okay, that monthly. The monthly payment on scenario 1 is $4,844, and that's at 6.25, Once it drops 1% to 5.25%, that scenario goes to $4,668. Okay, the savings there is $176 a month. Now, I'm not saying that's nothing. That is definitely something. Okay, but let's say it takes 12 months for interest rates to drop. Okay, that's a little over $2,100 in additional expense for that person. Okay, and I'm not trying to qualify if they get a buy down or whatever the case is, right? But like those people that want to hold off and try to get a better rate, it's $176 a month. Okay, if they were to also include the cost of a refinance, which is going to be somewhere around $3,500 if you're just including title fees and mortgage fees, not property taxes, insurance, HOA, because all of those things are just reoccurring for owning the property in general. But just general mortgage costs, okay, that person's, it's like $5,612, right? So $5,612. Now, a moderate appreciation is what in the value?
4%, 5%.
4%, 5%, okay? So I did a 4.2% appreciation, which is just conservative. There's some areas, guys, that are still close to 10%, you know? So 4.2% annual appreciation, that's $29,421, okay? If you minus the cost of having to refinance and pay higher payments, that person nets $23,809. Okay, for buying today. That's the cost of waiting. Now, that scenario really never breaks even, right? Because the longer you pay, you know, whatever you're paying, the less time you actually appreciate, right? So even if it takes 2 years, right, to get to that same level, now you've only doubled the appreciation for the property, and the costs, right, go up by $2,100. Does that make sense? So you just want to show them it's a 17% return on their cash investment. Now, you guys sound like you invest. How many investments do you have that have double-digit returns?
I do.
What kind of
It's
investment?
at Starlink. It's with my dad. We own like a couple thousand shares of Starlink. He's worked there for 20 years.
Okay, but how much is the?
He bought it at 18. It's worth 536. He did a 10-1, so now it's about $56.
Okay, this is a high. But what other investments do you have that return?
I really don't play around in the stock market. Besides like defense contractor stuff, but that's been crazy because the war in Ukraine has been making it triple. So.
Okay, so typically you can get like double-digit returns on minerals, on government, military. No, seriously, this is what it is. On a flip, on short-term gains. I mean, I bought Zoom stock. I had a 400% return. That's like unheard of. They're called anomalies. Okay, real estate is pretty much tried and true. That 17% return after 1 year, if you put 20% down, is always constant. This is the replicatable number. Okay, now that same person foregoes $23,000 in 1 year. In 2 years, it's close to $50,000. Okay, but that same person now has to pay $30,000 more in expenses because they waited to buy. So that's an $80,000 penalty for waiting. Okay, is that life-changing, tangible value for a first-time home buyer or move-up buyer? Okay, this is the type of thing you have to get really good at. The number one objection you guys are going to get when interest rates drop is that whole "it's going to get better." Okay, if people are going to want to wait for lower rates, and other people are going to think the market is crashing. It's just what happens. And so if you don't have a strong message with a proven pathway to success, you will sound like a salesperson with no value. Okay? People will pay. How many of you guys have paid higher prices to get expert value? Like, I pay more for an attorney, right, that has a proven track record of success than I would pay for just legal advice. Like, my CPA is more expensive than my last tax preparer because he will save me more money in taxes down the line and give me better advice. Will somebody pay you a 3% commission for this type of value and expertise versus somebody who is just writing a contract and showing them a house because they called on Zillow? This is the type of stuff you have to have in 2025. This will not be a market for brand new people. People have too many questions. The economy's too scary, there's a military conflict, the cost of just life is so expensive. So you have to take it seriously and decide like that you are going to learn this stuff. Just so you know, I know it's very high level and very comprehensive and sounds like a lot. Like I threw a lot at you in a short period of time. But just know, I am literally from Nogales, Arizona. Do you guys know where that is? It's like the little tiny border town between Mexico and Arizona. Okay, technology there is like 10 years behind. Okay, and I graduated with a women's studies degree. Okay, so I wasn't just naturally born with this information, and the tools that you have today with ChatGPT and Google and articles and X and all the things that is available to you, this information is very accessible. And it's awesome because it's information that you can disseminate every single month, if not on a weekly basis, with phone calls, with videos, in a newsletter. Okay? So here's the strategy moving forward, okay, for 2025. Number one, you need to figure out who your niche client is. You need to figure out what their biggest hurdles are going to be to buying in 2025 and what your like tangible, quantifiable, and replicatable value is going to be for them. You need one. Okay, that's the message you are going to put out every single day, if not every single week, on social media, in phone calls. You want to be known as that person. Okay, that's the person that makes me $100,000 in real estate in 5 years or less. That's what that sounds like. That's how people are going to refer you. Okay, how you're going to get this information out is one, phone calls, they can't be replaced. In-person meetings cannot be replaced. Okay, you will want to have, if you're wanting to have big success, you'll want to talk to 60 people per week. Okay, which is however many phone calls till you talk to 60 people. Then you will want to see at least 3 to 5 people belly to belly. Okay, you'll want to get out one newsletter a month that has these market stats and tangible advice, not just information. How do you use this information to win? That newsletter has to bring them somewhere. It has to bring them to a class, a Zoom, an in-person meeting with you. There has to be a call to action, but like you sell with little information over time and you close in person. There is no closing really online. Okay? Now the same information that you put out in a newsletter has to be on your social media, and if you don't have social media or don't like social media, get with 2024. It's important. People don't want to work with someone they can't Google. Okay, your information is available. You don't like it? Work on a team with leads. Right? But you want this information daily on social media, and you want it on video, and you want it on Instagram. So YouTube and Instagram. Okay? I like YouTube because if you get any traction, you can get money off of YouTube, and it also becomes a passive way of generating income. There have been times when my YouTube channel has made me $2,000 a month. Okay? It's better than a poke in the eye. Right? Who could use $2,000 to invest in their marketing? Right? $2,000 is a real estate commission in this market. Okay? So just know, also Instagram is now starting to monetize. When you monetize, they push out your content. So you will want to monetize. Okay? So you're going to do a newsletter. You're going to want to send them to a monthly event that you host. You're going to want to post it on social. Also send people to your monthly events. I host about 3 to 5 monthly events every month where I educate my clients or my real estate partners on what's happening and how to make an investment. My newsletter specifically teaches you how to educate them on what the opportunity is today. Okay? The opportunity today will not be for everyone. Okay, but you need to know what the opportunity is. Okay? Now, does anyone have questions about how to deliver that information?
I guess my question more so is like, how do you kind of pull those numbers, or like how would we pull those numbers to kind of present to people? I know you gave the example of the 700,000, house, but how would we kind of pull those numbers without kind of going into your world of the lending side and kind of presenting ourselves?
I think you can use that example actually.
Okay.
I think literally you might have to, we would happily give you whatever those numbers are for the market.
Mm-hmm.
but you will have to know your area specific,
Yeah.
right? So if you have a client that wants to purchase, part of your buyer presentation should show them, hey, in this zip code, this is what you can expect approximately for appreciation, and should show them the cost of waiting. Like, that should be part of your buyer presentation. Like, I will tell you, I meet with tons of real estate agents, and let me tell you what's not in their presentation. Like, real investment value on how that property is gonna perform, right? So, that is actually, I would have a cost of waiting page on whatever presentation you're gonna have. Okay, that's a wonderful question, by the way.
What would you say, how many years when you do that buyer presentation?
It depends on the actual area, right? So there's some areas that have a very low appreciation, so you're gonna wanna have that person own their house for longer. So you also wanna know, like, you know, home ownership right now that interest rates have been low is upwards of like 13 to 17 years. It's kind of nuts. But people started getting low interest rates back in 2008, right? Up to 2018 is when they started going up. So they've had a long time of owning that house with a low rate. So depending on the appreciation, you want something at least at 4 to 5%. That's another really great question. What else? How many of you guys don't know where to start? Like, with who to contact? Okay.
I'm brand new.
Okay, so if you are brand new, what I would do is I would try to locate in my database about 300 people, right? And these could be from any walk of life. Everyone knows how old are you? Like, approximately 30?
47.
Okay, great. You look great. All right, so you at least know about over 1,000 people in your lifetime. Okay, so you want to choose 300 of them. Okay, and we want to figure out what the demographic looks like. Are they in the same age bracket as you? What their income levels are? Where they live? Do they own? Do they rent? Right? How long have they owned? And depending on what your investment expertise looks like in real estate, I don't know if you've bought multiple properties or if you've been an investor or how you got into real estate, but you will want to impart some sort of expertise. So a lot of your friends probably have owned a property for longer than 10 years, I would say. Or they've never invested, right? It's like one of the two right now. So for people that have actually owned their properties for 10 years, this is an actual thing. They should look at actually upgrading their primary residence, especially if they're in your age bracket. Okay, so I'm 41, this is the same age bracket. Okay, so I am looking at upgrading my primary residence and maximizing my qualification. So people should own something between 3 and 5% of their income in a mortgage. Okay, so I'm going to give you an example of why this is important. Okay, so I have a client that bought their house in 2013 for $168,000. He called me for a cash out refinance because he wanted to upgrade the property, renovate the kitchen, he wanted to renovate the bathrooms. And I said, great, if you did all of that, it's approximately somewhere around like $125,000 he was going to be pulling out. And I said, you have a little over $200,000 in equity at this moment. If you were to take that equity, pay off your current liabilities, and buy a $700,000 house, okay, that is going to be roughly around the same out-of-pocket costs for all of your debts and mortgage payment today. Now, the reason that that makes sense for you is because you're going to upgrade this property, and it's going to be worth somewhere between $375,000 and $425,000. Okay, if we know that real estate doubles every 10 years. Okay, that's maybe $850,000 at the most. Okay, now for the same out-of-pocket monthly expenses, you can roll in your equity, buy a $700,000 house, and in 10 years, that property will be worth $1,500,000. Okay, when you're looking at retiring or downsizing, right, in another 10 years, okay, $1,500,000 is a lot different of a retirement than $850,000. Okay, and that's the conversation you will want to have, and you'll want to use your own personal experience of owning a house, not owning a house, buying multiple properties to explain the story and why you're doing it too. So it helps that I'm currently doing this myself, right? So when I talk to my friends and my family, and we're talking at Christmas, or I'm explaining this to my clients, this is what that conversation sounds like around the holiday table. Hey, well, have you considered, right? This is what my real estate advisor explained to me. Okay, again, we're talking about tangible, quantifiable, life-changing value, right? When you're downsizing and you can buy a $600,000 house and have $1 million in investments, that's a whole lot different than $400,000. Like, it's just not the same. Okay, so you will want to start with friends and family. You'll want to explain the market opportunity. You want to use your own experience if you're newer, right? Have you owned a home? Do you own a home?
Oh, yeah.
Okay, right, you can use your same exact scenario and how you're doing it for yourself. That's how we explain it, and you'll want to say, hey, I'm making a straight up business call right now. Like, don't do the whole, hey, how are you? I mean, talk about your life and let me somehow segue to real estate. That's what salespeople do. Okay, business people say, hey, I'm actually calling you on official business today. I don't know if you know, but I decided to invest in real estate. I'm upgrading my primary residence. Here's what my deal looks like. I know you've owned your house for 10 years. I ran some numbers for you. This is actually what it looks like for you. Have you considered selling? Have you considered doing this? Okay, when you bring somebody life-changing money value, okay, they won't want to look another place. And even if you have no experience in real estate, you have experience in money. And people who've been experienced in money success, people believe and follow and pay more for. Cool. All right, guys. Well, that's what I brought you today. Thank you for being patient. I apologize for being late. Now, if I brought you a nugget of information you can use in your business, raise your hand. Okay, cool. Because I'm not a professional speaker. I am a loan officer, and so I hope that it's valuable enough for your next referral. So thank you. Appreciate it.
Thank you.
Do you have my cards, Kristen? Do I have cards? We need cards. I will give you my cell phone number.
Yes. And
Card
we'll give you your
cards,
info.
Yeah.
We need to update them. She has short black hair in the picture, so.
I don't know. I thought it looked good. You know, the blender ears.